Welcome and thanks for joining us. We've got a great session coming up with Robert Leitz, Portfolio Manager of Iolite Partners based in Zurich, Switzerland. Robert founded Iolite in 2008, having previously worked at hedge fund TPG Credit, at Goldman Sachs in their European Special Situations Group, as well as at KPMG in their corporate restructuring practice. So clearly, Robert has a great skill set and experience as an investor across the capital structure. He's also demonstrated how that helps him as an equity investor in his current role. Since his fund's inception in 2008, Robert has generated annualized net returns in excess of 15% with no leverage, including a 41% return in 2012. Past Value Conferences attendees will remember Robert from his very insightful presentation at European Investing Summit back in October 2012, where he made a compelling case for several Greek-listed equities which have performed very well since then. Today, Robert will present the investment case for his favorite small cap idea, an equity listed in the UK. And with that, Robert, please go ahead.
Great, Oliver. Thank you so much for the introduction, and it's great to be back. So I want to spend the next 30 minutes or so to talk about Quarto. That's a US-UK publisher of illustrated books. Basically, Quarto popped up in value screens. It's trading at just 3.5 times EV/EBITDA. And also just recently, an activist shareholder, Harvard Capital, ousted the founder, chairman and CEO Lawrence Orbach, who ran the company for 36 years. So I think it's an interesting case, and obviously the big question is, given the seemingly low valuation and shareholder activism, could Quarto be an attractive investment opportunity? The focus of this presentation will be on investment process and hopefully provide you with valuable insights into my approach and thinking when analyzing stocks. So in the course of the next 30 minutes, we will take a look at the company's products and business model, the publishing industry's dynamics, Quarto's financials, its valuation, and the best strategic options going forward for the company. So let's start taking a look at the products first so that we get an idea of what they're actually selling. As you can see, Quarto is one of the largest international illustrated book publishers with two principal strands of activity. Its publishing segment publishes books under imprints owned by the group, and its co-edition publishing segment creates books that are licensed to third-party publishers for publication under their own imprints in many languages around the world. As you can see from the pictures, most of Quarto's books are heavily illustrated. So they are coffee table books that you would give to friends, display in an office environment, maybe display in your household. Common themes are art and craft, culture, history, sports, design, gardening, cookery, transport, food and entertainment, lifestyle, health and beauty, games, digital video, or stage and screen. So again, it's a lot of pictures and something that you want to hold in your hand. That's important for the later analysis. So to the next slide, let's talk a bit about the business itself. Quarto was founded in 1976 and it's based in London and New York City. As already mentioned, the company publishes illustrated non-fiction books in co-edition and under its own imprint for adults and children worldwide. The largest segment, publishing, generates about 2/3 of the company's revenue and profitability. It generates $123.5 million in annual sales and about $12 million in profits, so that's a 10% margin. The US is the largest market, accounting for about 56% of segment sales, followed by Australia and New Zealand with about 28%, and the UK with 16%. Reprints make up about 60% of revenues. The level of investment that goes into creating each title is greater than for most books produced. So Quarto recoups this investment by publishing books that are intended to remain in the market for many years before requiring extensive revision. The other segment, co-edition publishing, accounts for about a third of group revenue and profitability. It's also running at a 10 to 11% EBIT margin, and reprints also make up about 70% of sales. Quarter has grown both organically through acquisitions around the world. It now employs about 500 people in 20 separate business units in the US, UK, Australia, New Zealand, and Hong Kong. Annual personnel expenses are around $30 million. So overall, the group publishes 600 new books for adults and children each year, sold in 35 countries and in 25 languages. 60% of sales come from a backlist of more than 9,000 titles, and no single title exceeds 1% of group revenue. While digital revenues are growing strongly, this is from a very small base. In 2011, digital sales accounted for just 2% of annual group revenue. So let's take a look at the geographic footprint of the group. As you can see, the majority of sales are in Anglo-Saxon countries, with the US being the most important market, generating about 44% of revenues, followed by Australia, 21% of sales, and the UK with 17%. The rest of the world, predominantly European countries, account for about 18% of group sales. Overall, the group seems fragmented to me. Let's remember that Quart is a niche publisher with not even 200 million sales, but they still have offices in 12 cities around the world. And looking at the next slide, you can see this also in the group structure. Unfortunately, Quart does not disclose information that enables a deeper look into the company's cost structure. The founder and the CEO, Lawrence Orbach, wrote lengthy and quite interesting annual shareholder letters that provided great insights into his thinking, as well as his assessment of the publishing industry and the overall business environment. However, in some ways, those letters should also be taken with a grain of salt, as they tend to frame the reader, that is, channeling the reader's perception of the company and its financials. I hope that new management will provide deeper and better insights into the company's financials, its cost structure, and what needs to be done going forward. Looking at the industry dynamics, as we all know, the book publishing industry is a mature industry facing significant headwinds. Internet retailing, like Amazon and Apple, is leading to a reduction in traditional bookshops and also puts a lot of pressure on retail prices. The rise of free or cheaply available ebooks has led to a reduction in the perceived value of books. Publishers increasingly get squeezed on margins. For traditional book publishers, high pressure on sales prices and cost inflation are real issues. The shift from paper to digital is a costly process requiring significant investment in technology and talent. And I would argue that digital publishing requires a different skill set and culture from traditional offline publishing. And lastly, the issue of handling physical inventory is becoming an even bigger issue for traditional publishers and bookstores in this changing environment. Thus far, Quart's strategic position has been to stick to what has worked in the past. In his last shareholder letter, Lawrence Orbach said Quart Group, as one of the world's largest publishers of illustrated books, has been little affected by ebooks. He believes that Quart's book output is substantially non-fiction titles that are useful and often necessary for readers pursuing a craft, a hobby, home improvement, or self-improvement. To him, this is not a large part of the current ebook market, and efforts to build both apps and ebooks around the kind of content they have created has not been well rewarded. At the same time, he does acknowledge that all publishers are increasingly moving into online retailing. In his words, and this is from the last quarterly statement, they have noted that licensees and distributors around the world are largely adjusting to a world in which online retailing and digital books have challenged long-entrenched business models. So I don't know how to properly assess the statements. On the one hand, he says Quarto is not affected, but on the other hand, he does acknowledge that the industry is changing and that more and more publishers are moving towards the digital business model. If you ask me, I believe that the rise of even lighter tablet devices able to display books in brilliant colors and animations will definitely have an impact on the publishing industry. And tablet devices capable to replace color books, such as the iPad or Amazon's Kindle Fire, have only been around for 2 years or so. So really don't know what the publishing industry will look like in 5 years. At the same time, and while digital content poses enormous threats to established book publishers, the technology enables existing players to easily reach wider audience on a broader geographic footprint and without the need to handle physical inventory. So again, it's often if there's a disruptive technology, there's risk, but there's also chance. We can look at the comps. I quickly pulled up kind of a few comps of competitors. It seems that overall UK publishers are trading at a significant discount to American peers if measured by EV to sales. And that could be a result of their smaller size and also lower margins. What definitely strikes out to me is that Quarto's gross profit and EBIT margins are well below industry benchmarks, and that Quarto has one of the most aggressively levered balance sheets in the industry. And also, Quarto's accounting practices appear more aggressive than those of other industry players. Just compare EBITDA with EBIT, and we will get to this later. Still, based on EV to sales or EV to EBIT, the company doesn't seem overvalued if measured to its peers, at least not at first glance. So now I would like you to look at the financials in a more detailed way. First, we will start with the P&L. I do like that the company has a history of consistently growing sales, gross profit, and EBIT. Overall, the company's top and bottom line seem quite stable and resilient to economic downturns. What I don't like is that Quarto publishes little detail about reported sales and COGS, so it's difficult to properly assess Quarto's operating efficiency and cost base. We do know that personnel expenses make up about 30 million. That's about 30% of Quarto's cost base, and that Mr. Orbach was paid $1 million a year. That's maybe a bit high for a company of that size, but we don't know much about other expenses like sales discounts, fees to authors, production costs, travel or marketing expenses. And another worrying point to me is that reported earnings are of a low quality. You can see that there are high recurring so-called one-off amortizations and exceptional items. Then there are dilutive minority shareholders. And starting 2005, the group separated reported foreign exchange effects and foreign exchange hedges. And looking at the numbers, to me, it all seems a bit nonsense. So I don't really know why they're doing it. It doesn't seem to have a big and positive impact on the company. Next is the balance sheet. So overall, it seems to tie in quite well with what we've seen in the P&L. The company has grown nicely over time, mostly because of acquisitions that were financed through operating cash flows and net debt. Quarto boasts high returns on tangible capital. However, there's also high investment into intangibles that one should also consider. While PP&E is only about $10 million at current carrying value, or about 5% of the total balance sheet, intangible assets account for $100 million, and that's 50% of a company's balance sheet. There's a lot of goodwill created through acquisitions, but also from capitalized pre-publication costs since 2005. Capitalization of pre-publication costs is a crucial point, and I will come back to this later. We can see that there are significant dilutive minorities, and the company carries a lot of debt. Management has done a great job refinancing due loans of $80 million in 2011, and the company now has sufficient liquidity for at least another 2 years. I like that the company has positive working capital of around $30 million, though high inventories and trade receivables can also be subject to write-offs in an environment where book retailers go out of business, paper volumes are down, and online volumes are up. Looking at the next slide, Also, the cash flow statements fit nicely with what we see in the P&L and balance sheet. Again, we see aggressive accounting, high levels of goodwill, and capitalized pre-publication costs. We see high capex for acquisitions. We see increasing interest payments, and that's not because of rising interest rates, but because of rising levels of leverage. We see that acquisitions are financed through a mix of operating cash flow and net debt. And we see that Quart has a nice history of paying steadily increasing cash dividends out of a mix of operating cash flow and new debt. Now, I really don't like the fact that the company capitalized about $90 million of pre-publication costs in 2011. Let's remember that about 70% of group sales are from backlist titles, and that the company only publishes 600 new books a year out of a library of 9,000 titles for sale. I believe the company's accounting became more aggressive over time to facilitate new debt and acquisitions. In my mind, it would be wise to adjust EBITDA downwards accordingly and return to more conservative accounting standards. Also, the key ratio analysis reveals what we've seen so far, known patterns and issues. As discussed, we see the stable character of the business in the gross profit and EBITDA margins. I like that share count has been stable over the last 10 years. And I think overall, the last 10 years show an impressive growth in owner earnings per share, and also book value per share. I think while Lawrence Auerbach might not have been the best business operator, the numbers suggest he was a good, if somewhat aggressive, deal maker. So let's just sum up what we just discussed. Based on the financials, I think the strengths of Quart are that sales, earnings, and margins are keeping up quite well despite the publishing industry's demise. The company has a lot of positive working capital. Recent refinancing reduces liquidity risk. The company has a history of growing cash dividends. The leveraged balance sheet provides high return opportunities for shareholders. We see good growth through acquisitions, funded out of free cash flow and debt. And historically, the acquisitions were mostly value accretive. That is through growth in earnings per share and book value. The weaknesses of Quart, in my opinion, are the significant business model risk through disruptive technologies, that margins are below industry benchmarks. The group, in my mind, is an amalgamation of weakly integrated assets. I think EBITDA and earnings are of low quality. We see capitalized pre-publication costs. We see dilutive shareholders and minorities. We see recurring one-off expenses, and we see nonsense hedging and foreign exchange risks. We see a highly leveraged balance sheet, which could also be a risk, and the quality of the inventory and trade receivables could be subject to impairment risk given the industry environment. And lastly, and this is just an intuition, companies with a track record of aggressive acquisition-driven international growth have often been subject to issues in reporting reliability. So this is a point where it's soft. We don't really know for sure. Let's take a look at the recent shareholder activism and what has been kind of happening in management. So the weaknesses that we just discussed are why shareholders got involved and forced 70-year-old founder, chairman and CEO Lawrence Auerbach to resign in late 2012 after 36 years as the head of the company. As you can see in the table at the bottom right, the shareholder base is quite concentrated. So there's a free float of at least 24%, depending on, maybe some of the smaller shareholders listed there might be able to sell or might be wanting to sell. The main shareholders driving the changes at the top are Harvard Capital, it's a private equity firm, and the Wellcome Trust, the world's second largest private funder of medical research after the Bill and Melinda Gates Foundation. In the words of Harvard Capital, the reasons behind the forced changes are Mr. Ortberg persisted with a misguided acquisition strategy, delivering volatile earnings, lackluster share price, and a substantial increase in debt. And I believe this corresponds quite closely with what we've seen in the numbers ourselves. Harvard installed one of its representatives, Timothy Chadwick, as the company's new chairman. And Timothy has stated that he wants to look at all the assets one by one to assess what to do with them, how they fit, and whether they work within the group. He wants Quarter to embrace ebooks as the company is lagging badly behind rivals such as Bloomsbury. And he believes that Quarter's self-help and how-to guides are perfect for the growing middle class in China, India, and South America. So this is, I think it sounds good. So my concern, while all of this sounds good, is that new management has really come up with, has to be quite strong in order to successfully implement those changes. The new CEO, Mr. Lieber, was actually hired by Mr. Ortberg himself to succeed him. And from what I've read and seen, and admittedly that's not much, I don't have a very strong first impression of him. And Tim Chadwick, the new chairman, has been described as a rather weak business operator. He seems to know how to sell a business, though if the track record is, looking at his track record, he seems to know how to sell a business. But again, there seems to be doubts about his capabilities as a business operator. So summing all, given kind of our analysis and without having deeper insights into the company, my strategic recommendations to management would be on the operations, to focus on cost, not acquisitions, to improve margins by taking a close look at pricing, processes, and synergy potentials, to carefully invest in ebooks, geographic reach, and cost improvements, to generate cash and deleverage the favorable asset disposals. On the financials, I would recommend to use less aggressive accounting and to reintroduce meaningful EBITDA measures, to take a close look at group consolidation for possible hidden issues, to squeeze out minorities, to free liquidity through working capital improvements, to stop the FX hedging nonsense, and to keep leverage at current levels at best. In terms of capital allocation, I would tone down growth ambitions, and I would start returning cash to shareholders through buybacks or dividends. A good mix could be to invest 25 to 50% of operating cash flow into business improvement and to invest 50 to 75% of operating cash flow into buybacks or cash dividends. I believe there should be plenty of opportunity to create shareholder value. Most importantly, I think Quarter needs to find a new, better, and clearly defined strategy that focuses on business consolidation rather than acquisitions. And this is because the business environment is changing dramatically, and it might be useful to stabilize the company and return cash to shareholders. I also believe further management changes might be necessary. Quarter will definitely need the right talent and culture to be able to execute the new strategy. Again, it's just an intuition. I'm not sure how progressive the company's culture is, given the strong impression that former management was focused on deal making rather than operational performance. I just have an intuition that there might be a change in the culture required going forward. So the investment idea, I would like to express in a bull and a bear case. Overall, I believe the upside outweighs the downside. However, I believe that it will all depend on the strategic, operational, and financial capability of the new management. So the bull case, and this is if everything goes right, and I think there's a high likelihood that actually you can achieve the bull case. So you acquire a solid and operationally undermanaged asset for 8 to 10 times EV to owner earnings at current prices. There's a good opportunity that the market is overvaluing risk from disruptive technologies. And I believe there's significant potential to improve operating profitability, to improve liquidity by scaling down investment into new books, and to free working capital liquidity. So annual returns of greater than 20% should be possible through shareholder-friendly capital allocation. If we keep leverage at current, sustainable 5 to 7 times net debt to owner earnings, if we return operating cash flows to shareholders through buybacks or cash dividends, and that's all because the business is currently just trading at 3 to 5 times market cap to owner earnings. In the bear case, and this is a downside, you would acquire a solid, operationally undermanaged, and overly levered business with strong industry headwinds for 8 to 10 times EBITDA owner earnings. You might be more pessimistic about the business environment and operating profitability going forward. You might think that there's high business model risk through internet retail and e-books. There might also be higher capital expenditure required to increase e-book and market share. And it might be difficult to change a sleepy corporate culture and acquire good talent. So in this case, you would probably want to carefully scale e-book business, carefully scale the e-book business, as well as the geographic reach, perhaps Asia, as Timothy Chadwick mentioned. You would want to realize synergies after a good and thorough look at key assets and operational overlaps. You would use operating cash flows to deleverage and thus de-risk the company. And in this case, the annual returns would be very dependent on just the future business model, and I wouldn't put a price tag on this. So again, in the bull case, I think you keep the balance sheet levered. The industry, the view would be that the industry is more stable than it appears, and you would just aggressively use the operating cash flows to buy back stock or to pay dividends. And because the company is just trading at 3 to 5 times market cap to owner earnings, you might get your money back in like 3-4 years. And again, in the bear case, you would take a more pessimistic view on the industry environment. So there might be a decline in sales, decline in margins. You would have to spend more capex to kind of rescue operating cash flow, and you would use cash to delever the company in order to take out some risk. But I think the likelihood that you would lose all the money is actually quite low. So the downside, again, I wouldn't put a price tag on it, but it really depends on your view on the market. But it should be there should be a lot of space for operational improvement. So this ends my presentation. I hope you enjoyed it, and I look forward to your questions and comments.
Well, Robert, thank you so much for this very thoughtful presentation on Quarto. I'd like to just refer anybody in the audience with questions for Robert to feel free to get in touch with Robert directly or visit the online conference area where you can post a question there. Robert, I have a few questions also. Perhaps worth touching on first is if you could tell us a bit more about the current ownership following these changes. Do you expect any doubt as to who is in control here?
Right. So I'm actually very comfortable with the new owner. I think it's a great change for the company, for the business. So first, as I said, I don't think that the founder did a bad job. I think he was a great deal maker, and he actually has created shareholder value also in the last 10 years. But I think now the industry environment is changing, and you have to take the business into a different direction. So now there should be more focus on consolidation, maybe new technologies, and also paying cash back to the shareholders. And this is where the new shareholder stepped in, or the kind of the new controlling shareholder, Harvard Capital. And I really like what I said so far. Like they mentioned the right issues. They also provided hints where they want the company to move forward. And I think so whatever they've said so far points into the right direction, and I'm really comfortable that they're in the business. So very happy about the new shareholder, and I think they could potentially create a lot of value for all the other shareholders as well. So for me, it's almost like a public leverage buyout. It's highly levered, so there's a high opportunity for high returns, and I'm hopeful that Howard Capital is kind of freeing or like making really realizing this opportunity for all the other shareholders as well.
Can you talk a bit more about what you actually see happening operationally and driven by this new ownership? And then for you as an investor, what's perhaps your base case expectation? Give us a bit more sense what you actually expect, both from the business and then from the perspective of an investor.
Right. So what I do expect is that we've seen a lot of kind of acquisition-driven growth. I want this to stop. I want them to take a deep look at the assets and see whether they are all profitable, whether there are any issues in consolidation, in the consolidation process. And I want them to provide more transparency in the cost structure and what how they can lift margins. I mean, the peer analysis showed that the company does not have high margins. There's a lot of aggressive accounting. So I want them to just be very open about accounting, about cost issues, and about how they want to improve margins. I think margin improvement is very, very important. And then secondly, so as I said, the business model is changing from kind of the print publishing to the online publishing. I don't expect them to aggressively invest into digital content. I think the wise approach would be to kind of carefully move all the kind of books to a digital platform, but this doesn't have to be done overnight for all the books. So I think it would be wise to be somewhat careful and to spend cash carefully there. They did mention that potentially they could grow the geographic footprint, and this is also something that I didn't understand when looking at the company. It's illustrated books, so it should be fairly easy to just translate the little text there is and then increase the geographical footprint. And this might also be something from the sales perspective that the company has not really exploited. I think they just acquired a lot of assets and then they just kept them, but really like improve margins and just distribute the books in also non-English speaking countries. So there's a tremendous upside. From like an investor's perspective, what should they do? I think they should start paying back cash to the shareholders quite quickly. It's a levered company, and I believe they can actually, the leverage is sustainable at least for the next 2 years. The company has performed very stable over the last few years. I don't think sales are going to drop off immediately starting tomorrow. We have a positive working capital. We have a huge backlist, so you could potentially also reduce capital into new capex into new books to just kind of keep your current book library and sell it for a few years. So there's actually high visibility in terms of just sales for the next 1, 2, 3 years, right? So again, kind of check whether it makes sense to actually invest in new content and whether this investment is spent wisely or just kind of sit on your current library and free cash and then return the cash to shareholders. Now, buybacks would, in this case, would make a lot of sense, but maybe they, depending on whether they can actually acquire stock or not, it's not that much of free float. They could pay dividends. Overall, as I said, if you're acquiring the company at maybe 2-3 times cash flow, like market cap to cash flow. So if they're aggressive in paying back, in kind of freeing liquidity and paying this liquidity to shareholders, you would probably be able to get your cash back in 1, 2, or 3 years. It should be quite easy, and I would love them to do this.
And just to clarify on that, so when you say the market cap to cash flow is about 2 to 3 times, does that assume that they actually reduce the pre-publication costs and sort of scale back the growth initiatives?
Right. So the way I look at it is right now the market cap is about $45 million. And if you look at the cash flow statement, so the way I defined owner earnings is about kind of 12 to 17 million dollars, which would mean like a 3, maybe 4-year payback. But in those owner earnings, I conservatively included the capex for pre-publication costs, which is quite high. And then if you would scale down those pre-publication costs, you would be able to free maybe another $10 million. So overall, you might look at owner earnings of maybe like about 20 million, which is kind of half the market cap. And we also look at working capital, so they have a huge inventory. They have trade receivables. They do have cash, and then also if you return some of that cash to shareholders, again, the market cap is very small. So you have 30 million in working capital, and you have a market cap of 40 million. So looking at just owner earnings, maybe improving owner earnings by reducing pre-publication costs, and potentially also improving working capital, you should be able to really free a lot of liquidity. And because the market cap is just 40 million, you could look at a payback of maybe 2 years, and arguably you wouldn't really risk the business doing so. I think the business might actually do quite well, even though you take some cash out.
Great. Well, we're going to have to end it here. Robert, thank you again so much. It's, as always, a pleasure to speak to you. It's, again, a great work, and thank you for this idea.